Hello, and welcome back to the continuing lecture in corporate finance. Now, from our um, previous lecture, where we discussed the examples of break-even analysis, right? We are continuing on with the operating leverage, right? And the effect of, first of all, we understand what operating leverage is. It is the the leverage coming from the use of more uh, uh, fixed assets, or in other words, plant and equipment, or uh, physical capital, right? So the so let's take a look at these two examples, right? Of course, the when you have either financial leverage or operating leverage, of course the leverage is directly observable in the in EBIT, right? Because with the leverage, the EBIT will have to be lifted, right? But by using more leverage, then the volatility would also increase. So with more operating leverage, right, as the quantity moves away from the break-even point, profit or loss would increase faster with more operating leverage. In other words, as the that means the volatility of the profit or EBIT increases. So that means with more volatility means more risk, meaning larger variation or variance in EBIT or business risk, right? Effect on expected EBIT, right? This is expectations operator, right? In other words, forecast, right? EBIT forecast, projected EBIT. When operating above break-even point, more operating leverage implies higher EBIT, right? But below the break-even point, greater loss, right? So two pictures, right? One, low leverage, right? The other one, high operating leverage. Low operating leverage, in low operating leverage, before you break even, right? Until you reach the break-even point, you will incur loss, right? The negative profit, right? But the magnitude of that loss is not that great, not that high. But after after you are past that point, break-even point, you see profit, but the magnitude of the profit isn't that much, right? And on the other hand, with high operating leverage, right, before breaking even, the loss is big, but after breaking even, the profit is also large, right? Very big. And in a everyday language, I mean, this is not necessarily economics parlance, right? But people in economics, of course, it's originated from economics, microeconomics especially. It's called, economies of scale, right? What is economies of scale? The greater the scale of production, right? There's huge savings, right, to the uh, huge savings to the cost, right? Uh, with and this may seem not directly related with this, but uh, with greater scale means what? You are using more capital, right? Rather than labor, you're using capital, more capital. And more capital was already, this higher level of fixed cost. It means, a larger scale of production with, more plant and equipment, large scale of plant and equipment. And uh, cost, total cost uh, doesn't increase that steeply because the mix of production production technology or the mix of variable cost is more into capital, less for each unit produced, right? There's less variable cost involved. So therefore, look at the steep um, line, right? The steep cost line, the slope of the cost line, right? The slope is very steep here because for each unit, additional uh, variable cost that goes into that um, uh, uh, is, mainly coming from the labor, right? Uh, so for each additional unit, the labor, uh, the proportion of labor and material, right? Mainly, labor, um, is what makes, cost, go up uh, you know, uh, by steep or slope. Whereas in this case, because a lot of cost comes from the uh, plant and equipment, right? It rather increases uh, uh, by flatter slope, right? And therefore, and even when, um, okay, I guess that's enough. Enough of that, economics of scale. And in everyday language, the way the economies of scale is, paraphrased is um, the benefit of mass production, right? And that says, in mass production, there's a saving on cost, right? So here, let's take a look at the example. Suppose firm A has fixed cost of $1,000 per unit per period, sells product for $10 and has average variable cost of $8. So then, the contribution margin or, gross profit per unit is $2. Further, suppose firm B has fixed cost of 1,500. Whereas firm B has higher fixed cost and also sells the product uh, for $10 a unit. You might wonder why, when the cost is, fixed cost is higher, why company B would sell it at the same price. Uh, but think about it. That means these two are competitors, right? And they are uh, basically selling homogeneous product, right? Homogeneous product means they can be substitutes, right? So they are inevitably competitors. So when the price has to be competitive as well, right? As a competitor, if you charge a higher price, uh, nobody will pay higher price for a homogeneous product, right? But anyway, let's see. Um, both firms are at the same break-even point. If they're at the same break-even point, right? The question will be a three-part question. What average variable cost must firm B have to achieve the same break-even quantity as firm A? In other words, with obviously price is the same, break-even point is the same, then the cost will have to be different. And of course, fixed cost is already different, right? So what should be the average variable cost per unit production cost, or CGS? And state the trade-off at the break-even point. Okay, which structure is preferred if there is a choice? So let's take a look at So both we can solve for break-even point first, right? Both firms have the same break-even point, 500 units. It wasn't given, but we can easily find it because if you divide the firm A's fixed cost, right, by the contribution margin or gross margin, right? Gross margin, gross profit margin, right? You get 500. So firm B has the same. So then simply a matter of solving for AVC in this case. If we do that, so 1,000 over 500, right, will be 10 minus AVC, right? So which will be 3. So 10 minus AVC is 3. So AVC should be 7. Well, this already this conforms to what we already the concept of this conforms to the concept of the operating leverage. When the fixed cost is higher, average variable cost is lower, right? So at break even, a $1 differential in contribution makes up for so for company B, for company B, contribution margin or gross margin is $3, which is better than $2 gross margin of company A. Okay, and that $1 differential in contribution makes up for $500 difference in the fixed cost. Now, that means saving of $1 in average variable cost makes up for $500 difference in fixed. So preferred structure depends on the volatility. If sales are expected to be highly volatile, right, lower fixed cost structure might be better in the long run. Yes. Why? Because think about it. With the higher fixed cost, right, which is the sunk cost. Fixed cost is the sunk cost because the initial investment is the investment in plant and equipment, right? You cannot easily downsize plant and equipment, right? And when the sales forecast is volatile, right? There's a good chance the economy there will be a downturn in the economy. Like there's a 30% chance downturn, a 40% chance of downturn in the economy, just 5% chance of great economy, great boom, right? 20% chance of normal growth, normal economy, and 10% chance of severe recession, etc., etc. Right? Those, depending on those, different scenarios, then there will be a wide variance in sales forecast or expected sales volatility. And in that case, it's easier to uh, it's easier to to manage with lower operating leverage because you can um, if there's the sales are horrible, you can downsize the manpower, right? The labor, downsize the labor. In other words, variable cost. I'm sorry to say, um, this is, it's a bad. It's not good to lay off people, right? That would be the hardest part. But uh, even if you're a very uh, 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 compassionate and sympathetic manager, right? Uh, unless you're not the owner, you're a hired manager, right? CEO. I mean, I've been telling you in the modern uh, corporate structure in a corporation, right? Manager is not necessarily the owner. Owner is owner of the capital, the equity holders, right? And the head of the equity holders is the chairperson, who is elected by the board of directors, and board of directors are like representatives elected by uh, the what the shareholders, right? Equity holders, right? And the equity holders demand ever increasing uh, return on equity, ever increasing earnings per share. The manager who cannot comply with that will get fired, right? So then, when the uh, revenue is not good, then you can easily downsize the labor, but you cannot easily downsize the capital. Make sense? You cannot easily downsize the plant and equipment. Anyway, so now we're moving on to the degree of operating leverage. You remember the degree of financial leverage? Degree of financial leverage is, once again, a kind of uh, uh, elasticity index or elasticity measure between uh, 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 the earnings per share and uh, the leverage, right? Of course, the formula itself is the elasticity between earnings per share and the EBIT, right? But then the change in EBIT is caused by leverage. Remember that? And then it causes change in the earnings per share. So eventually, it's um, the elasticity or sensitivity between the earnings per share and leverage, right? When I explained that as elasticity between EPS and leverage in the last lecture, some people might have wondered, scratched their head, isn't it? Isn't it elasticity between the EPS and EBIT? I mean, that's what the formula is saying. Yes, I'm not saying it is not. Well, what I'm saying is eventually, I mean, because EBIT is, affected, change in EBIT originates from change in leverage, right? That's why, it's eventually connected that way. Now, degree of operating leverage is, of course, think about it. Use of, eventually it's the sensitivity or elasticity between the EBIT, right, and the change in the fixed assets or fixed capital. But again, operating leverage, um, the result of operating leverage is the initial result of operating leverage is EBIT. Operating leverage doesn't directly affect the earnings per share. I mean, it will eventually because it adds volatility to the financial leverage, right? Uh, Eventually, but think about it. Uh, the outcome of the operating leverage uh, is, initial outcome of operating leverage is EBIT, right? Because it's about the cost structure. As the cost structure changes, right? Uh, how much will directly affect the EBIT, right? So it's like, this is once again elasticity uh, structure, right? Change in percentage change in EBIT, which is, change in EBIT over previous EBIT, right? And this is, percentage change in quantity. So that's, change in quantity over quantity, at the previous point, right? Or you do it also this way, just like, financial leverage, degree of financial leverage, another formula. Quantity time. So what is this? Quantity times P minus V. That's contribution margin or gross margin. So what is that? This is, gross, exactly the uh, uh, gross profit, right? Gross profit, isn't it right? Price minus variable cost, right? Is the average variable cost. That's the gross margin or gross profit. But that's per unit, and you multiply it by quantity, then that's the the in aggregate, right? Aggregate, gross profit, and then this is, gross profit minus what, fixed cost, and this is EBIT. If you think about it, gross profit minus fixed cost would be the EBIT. Finally, the operating profit. So this is the ratio between, if you think about it, this is the ratio between gross profit and operating profit. Right? Makes sense? And think about it. If this ratio is equal to 1, what does that mean? If the ratio between gross profit and operating profit is 1, that means you have zero fixed cost. There is no fixed cost. But the greater the fixed cost, what does this become? The ratio will be greater than 1, right? Because, if fixed cost, after subtracting the fixed cost, right? If fixed cost is such an amount that after subtracting that, uh, the EBIT or operating profit is just the half of the gross margin, right? Gross profit. Then the ratio will be 2, right? And if the ratio is 10, what does that mean? If the ratio is 10, there's so much, fixed cost that after subtracting the fixed cost, the EBIT will be only 1/10 of the uh, 1/10 of the gross margin. So obviously that means, there's huge, fixed cost portion. And I told you, if they say the gross margin, this is the gross profit, and it looks very wonderful. But, if they are hiding a fixed cost, then why is it? Why is that? Why is it that? Why is it, that they are hiding the fixed cost? Because fixed cost is so much, right? Fixed cost is so much that um, the there's hardly any, after subtracting the fixed cost, there's hardly any, EBIT left, right? And so the higher this ratio, that means, you're not likely to see a great EBIT, right? Um, but also another way of interpreting that is, there's a huge fixed cost, right? So that is basically, a degree of operating leverage, right? The ratio between gross profit and EBIT, right? Or operating profit. Also, if you try to make sense of this, right? Um, even though, think about it, even though the quantity increases greatly, if the EBIT doesn't increase greatly, that means what? It's because a lot of it is uh, uh, subtracted as fixed cost. Makes sense, right? Um, so once again, it's nothing new, but financial leverage involves substituting debt for equity in the firm's capital structure, and it's more controllable than operating leverage. Of course, because you just need to sell your, uh, uh, you just need to buy back your own stocks by by borrowed money, right? You borrowed $10 million and used it to buy back your own stock, then the capital structure. Of course, through buyback, the stock price would go up, and that's another effect. But in financial leverage, that effect wasn't discussed. But just looking at the leverage, increasing, and tax effect, the benefit of the tax effect, tax shelter, that alone, focusing on that alone would already explain why earnings per share increases and EBIT increases. So it's more controllable than operating leverage, and obviously more controllable than operating leverage, because operating leverage, involves, plant and equipment. I mean, how can you easily just, simply get rid of plant and equipment, or add more plant and equipment? It's not, so it's less controllable than financial leverage. Now, operating leverage involves substituting fixed cost for variable cost in the firm's cost structure. Yes, both can enhance the results while increasing variation. Both involve substituting fixed cash outflows for variable cash outflows. Yes, both makes uh, uh, it's understandable. It's easily understandable in case of operating leverage, right? More fixed cost and less variable cost. Yes, but then in financial leverage, what does this mean? Well, debt is increasing. Debt has fixed cost, isn't that right? Fixed payment, right? Debt has interest. Make sense? Interest payment is a fixed cash outflow. Debt is a uh, uh, fixed cash inflow, right? Whereas equity has variable cash outflow. In other words, dividend is a variable cash outflow, right? Whereas debt has fixed cash outflows. Both make their respective risks larger as levels of leverage increases. Yeah, when leverage increases, I've been telling you, the risk would also increase, because in good times, leverage would make outcome better, but in bad times, leverage makes outcome worse, right? That's the higher volatility, higher variance, higher risk. So here's an example of degree of DOL, degree of operating leverage. Alberghetti Corporation sells its product at an average price of $10. Average variable cost is $7. Total fixed cost is $600 per month. Evaluate the DOL when sales are 5%, and then 50% of the above the break-even output level. Okay, so first, let's find the break-even point. It's not difficult. TFC over contribution margin, right? Contribution 200 units, right? Then what is the 5% above the break-even level? Of course, 200 times 1.05, 210 units. 50% above it, 300 units. Degree of operating leverage, DOL, at 210 is quantity times, in other words, gross profit over EBIT, right? Operating profit. So 210 times, $3, and gross profit minus fixed cost. Okay, 21, right? And degree of operating leverage at 300 units, and then 3. So note that degree of operating leverage decreases as the output level increases above break-even point. Yes, that's the look. The volatility is greater when overall, because under the break-even point, greater under the break-even point, greater loss, right? But above the break-even point, greater profit, right? So over a large area, so like 50% above break-even point and 50% between this segment, right? Between this interval of output level, 50% below break-even point, 50% above break-even point. With this large, interval, right? The volatility in, there's a huge, loss and huge profit, so the variance is very wide. But with smaller range of output, just 5% below, 5% above, the volatility would be lower, right? So DOL decreases, right? The farther you go above, right? Break-even point, goes without saying. It's simply, if you look at the break-even analysis graph, it is quite, it's obvious. Let me just all righty, and then our next. So this is the diagram that shows how operating leverage and financial leverage affect eventually, on ROE and EPS. First of all, it's first of all, it's operating leverage, right? That directly affects the EBIT, right? Through and then with operating leverage, you can have improved performance, or amplified changes. As I explained a little bit ago. Um, and then the EBIT is amplified, the effect once again through the financial leverage. Uh, uh, During the good times, financial through the financial leverage, you will get improved performance, right? So ROE and EPS will go up, and then during the bad times, significantly lower performance, right? So it amplifies the changes, right? Both, DOL amplifies the changes in EBIT. DOF amplifies the changes in ROE and EPS. Okay. Now, another diagram, risk relationships. Risk and cost relationships between operating leverage and financial leverage. Now, operating leverage, of course, amplifies existing business risk, right? Financial leverage amplifies the financial risk. Cash outflows, operating leverage substitutes fixed cost for variable cost. In other words, you use more fixed cost in cost structure and lowers the variable cost. Financial leverage substitutes fixed return debt for variable return equity in capital structure. So debt from the investor's perspective, right? From the investor's perspective, debt, if you bought the bonds of the company, then you get the fixed income, fixed return, because it's bond pays, coupon interest. And then if you invest in the equity of the company, or even from the company's perspective, right? Equity gives you a variable return, right? That's the nature of stocks, right? So you are increasing debt, lowering, equity to achieve, optimal capital structure, right? So pretty much this will bring us back to the question of eventually optimal capital structure or optimal leverage. Before that, let's take a look at the total, right, degree of, because we have operating leverage and financial leverage, right? The compounded effect is called degree of total leverage. There will be a compound effect of operating leverage, and so degree of total leverage is degree DOL times DFL. That's the effects of financial leverage and operating leverage compounded with each other, right? Change in sales are amplified by operating leverage into a larger relative change in EBIT. Change in EBIT are amplified by financial leverage. So it was the diagram that you saw already, which will lead to larger relative change in ROE and change in earnings per share. So the result, modest change in sales can result in dramatic change in, it can lead to a dramatic change in, um, like a butterfly. What's a butterfly effect? The butterfly effect is basically a multiplier effect. Dramatic change in ROE and change in EPS. Combined effect is measured by, it's not, rather, combined is like additive, right? Uh, but, or concatenated. Uh, it's compounded effect, not rather than, combined. So I already talked about this. So there is, a variance in sales. In other words, there was volatility in sales. The sales can, range between, very bad to very good. Um, Through operating leverage, it's amplified, right? So variation in it. And through financial leverage, it's more amplified variation in ROE and EPS. Okay. So here's an example. Compounding effect of operating leverage and financial leverage. Allegheny Company is considering replacing a manual production process with machine. So replacing labor with capital. Money to buy the machine will be borrowed, so there will be financial leverage, right? So operating leverage will increase, and also financial leverage will increase. Replacement of people with machine will alter the firm's cost structure in favor of fixed cost, while the loan will move the capital structure in direction of more debt. Firms leverage positions at expected output levels with and without the project are summarized as follows. Currently, degree of operating leverage is 2, degree of financial leverage is 1.5. But with the proposed change or project, right, replacement project, right, degree of operating leverage will increase to 3.5. Degree of financial leverage will increase to 2.5. Then of course degree of total leverage will be this times this. But then let's see what will be the total combined effect. Economic outlook is uncertain, and some managers fear a decline in sales of as much as 10%. Decline in sales of as much as 10%, right, in the coming year. Evaluate the effect of the proposed project on risk and financial performance. See, sales would drop by 10%. That's the forecast, right? Remember, basically, eventually, this, variation in sales, that means, 10% drop, right? Negative, and then it will change, EBIT. It will change, 10% drop, of course, multiplier effect, there will be more than 10% drop in EBIT, or more than 10% drop in much greater drop in ROE and EPS. And so if we, so 10% drop, negative 10% times, DTL will give total effect and drop in earnings per share and ROE. So firm's current DTL is 3 because current this times this 10% decline in sales could result in 30% decline in earnings per share. But under the new proposed project, right? DTL will be much higher, 3.5 times 8.75. That means 10% drop in the sales could lead to 87.5 5% drop in EPS. Okay, so there's more volatility, but that also means, drop in sale would mean, 10% drop in sale would mean 87.5% drop in earnings per share. But think about it, 10% economic outlook is good. 10% increase in sale would result in 30% increase in uh, EPS, earnings per share, in under the old or current uh, capital structure and cost structure. But it will lead to 10% increase, will lead to 87.5% increase in earnings per share and ROE in the proposed cost structure and capital structure. Okay, makes sense? All righty, next slide. So we all understand, basically, this is a recap of why capital structure and leverage is important, because the value of the firm is eventually the result of value of the company is the result of the market value of capital components, right? And the market value of the capital components, equity and debt, market value, they are basically, based on the present value of future free cash flows, right? Remember? So does the capital structure affect the stock price and market value of the firm? Well, yes, of course. Capital structure, we've seen that capital structure affect stock price, right? And the market value or market capitalization. Market capitalization is only the equity part. So market value of a firm is both equity and debt part. If so, that you understand this, there exists optimal structure, capital structure that maximizes either or both, right? Does optimal capital structure exist, right? Same result, basically. We already saw this before, right? So we understand there is an optimal capital structure, right? And that maximizes, stock price and the firm value, right? So capital structure does impact the stock prices. Yes, there's optimal capital structure where stock price is the highest. There exists an optimal cap structure, and in previously, the book says, there's, it's difficult to actually pinpoint that capital structure. And still says there's no precise way to find it. But yes, there's, I mean, if you don't know calculus, you would say there's no precise way to find it. But if you know calculus, you can find it. It's simply, derivative, right? The first derivative of, stock price with respect to the change in stock price with respect to change in debt level, right? So is the basically a derivative, right? Where it becomes zero, right? rate of change becomes zero, right? First inflection point, as what the first derivative is all about. Now, the story of the theory of value of firm. Of course, the value of firm. Remember, I've been telling you there are three ways to gauge or measure the value of the firm. First one is, or estimate, book value. Book value is not an estimate; it's based on the book data. So total asset value of the total asset value is the book value of the firm, right? But once again, this is not the current most, it's not reflective of the most current market value. Why? Because I've been telling you, the book book value is always past, right? It's based on the past data. So second is the intrinsic value. Intrinsic value is, also called rational price or fair value because it's based on the rationally expected cash flow, right? Free cash flow, right? That's the based on the present value of rationally expected future cash flow. So that's the intrinsic value. Market value is, what market value, and as I said, market value is crazy in the short run because, a market value is, rational in the long run, but in the short run, it's kind of irrational. Why? There's a lot of, imperfect information, right? Information is not uh, perfect. And there are many missing pieces of information. That's why market is, see how a crazy market moves, all the time, but in the long run, in the short run, that's the case. In the long run, everything is uh, uh, priced in. So eventually, the long run market price uh, coincides with the intrinsic value, right? And this is basically the market value we are talking about is the long run market value, not in the short run. Stocks, move, in a very erratic pattern, Uh, so that's why, in the short run, market price is irrational, but in the long run, current market price reflects the intrinsic value. Okay. So some we all already understand, the value of debt, market value of the firm's debt, value of equity, market value of firm's equity, value of firm, which is, a sum of the value of market value of the debt, market value of the equity. And we don't consider value of preferred stock separately here. Value of the preferred stock is, still that's equity in technically, right? But practically, it is like debt, right? So it is, lumped up together. It is included either, here, treated like, uh, equity or treated like debt. Now, returns on the firm securities will be there are two, cost of capitals involved here, right? Because to calculate the market, to calculate the intrinsic value of intrinsic value of the debt, intrinsic value of the equity, you need to discount it. And the discount rate being used is the cost of capital. And for cost of debt, for debt, cost of debt is the appropriate discount rate. Equity for equity, cost of equity is the appropriate discount rate. And so, but uh, the free cash flow is the combined result of the both contributions of equity and contributions of debt, right? And remember, in other words, this is something we did in free cash flow valuation model in Finance 100. Companies that don't pay dividends, there's no way we can use dividend discount model to prices equity, right? Prices stock. So in that case, we have to use the free cash flow model to price the stock. And the free cash flow is what? Um, it's like the fruit of the tree, right? And the tree is called, total assets, right? Tree is the company, and the company is the basically total assets, right? Uh, Company's total assets are like muscles that work to uh, produce the result, right? And the result is the fruit. This tree's result is the fruit, right? Uh, so when you harvest the fruit, right, uh, that's the return, that's the profit, right? And then as total assets that worked hard to generate that uh, return to bear those fruit, right? That's the tree, right? So, but then think about it. The tree consists of not just one type of capital. It consists of both types of capital, equity and debt. So then the question is, how much of that fruit is the contribution from equity, and how much of that fruit is the contribution, result of the contribution from debt, right? And then there's no easy way to exactly um, uh, define it, but we know we have the rationale. We have the logic is logical. Uh, the logical conclusion is that at least think about it. If the capital structure was 70% equity and 30% debt, the result of uh, the fruit is the result of the 70% contribution, right, from equity and 30% contribution from debt. Makes sense? So that's how we can have uh, weighted average cost of capital. Weighted average cost of capital. Okay? And the symbol for that is KA. A stands for, of course, average, right? Weighted average cost of capital. So now we can value of the firm is basically value of, this is the market value of the firm, market value of debt, market value of equity. Of course, it's actually intrinsic value of the debt and intrinsic value of the equity, right? And then that's the intrinsic value of the firm. But as I said, in the long run, you would have an equilibrium, and in the long run equilibrium, right? Market value would be exactly equal to the intrinsic value. So you can also call them, operating income. And now think about it. Operating income is, slightly different from free cash flow because free cash flow is actually, operating income, uh, which is EBIT. Uh, from the firm's perspective, right? Operating income is different from EBIT or operating income, because from the company's perspective, operating uh, 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 cash flow, operating cash flow is EBIT minus taxes plus depreciation, right? And that's free cash flow, right? Free cash flow is uh, operating cash flow, and then the free cash flow will have to have the change in net working capital added to that. But this is from the investor's perspective. Investors' perspective, the operating income is largely, the interest from the debt and dividend from the uh, uh, equity. Makes sense from the investor's perspective. So value of the firm is basically, and this is the cash flow, right? So you projected cash flow, so you discount it, right? From the company's perspective, you discount free cash flow. But from the investor's perspective, uh, because your cash flow is interest plus, dividend, right? You discount it by uh, weighted average cost of capital. Okay, simply put, it's this way, but you know, uh, it's an aggregation, right? Sum of all the present values. This is just a single period, but if you have multiple periods cash flow, then of course you would have to sum all the present values of those, right? So returns then drive the value in an inverse relationship. Well, this is something we already know. I mean, they put it just like this, but what does this mean? Um, returns, this cost of capital. Value is an inverse function of, right, reciprocal of, uh, you know, um, there's an inverse relationship between the value of the firm and the cost of capital. Makes sense? This goes up, this goes down, right? That's something we already know. Well, we have okay, we have uh, also here. I'm afraid um, I guess the slide is flickering. I think we're out of time, but this is related to what we just talked about. So we will continue in the next class with Modigliani and Miller. Modigliani is a famous name in finance. Modigliani and Miller theorem. But this is like a graphical representation of optimal capital structure. So that's it for today. We will have to. I will see you. Thanks for watching, and I will see you in the next class. Okay. Thanks for watching. End of video.